Without further ado, I do want to introduce Joe Koza, who is one of our own, Smeal graduate, both the undergraduate program here in accounting, and then went on after a few years to get his MBA. Joe is in the private wealth field for JP Morgan Private Bank. Joe has done a lot of recruiting out there at Penn State as well as other schools like Wharton, so he is a veteran of the vetting process of how one gets into a good company like JP Morgan, and certainly a specialist in the world of private wealth. So we're very pleased and honored to have Joe here today with us. With that, I'm going to turn it over to Joe. Thank you.
Thank you. Thank you. I didn't bring any PowerPoints or technology or anything like that, because that's also a little bit of a comment on the business that I'm in, where we always say the best meeting is if you do bring a flip book, you never open it, because that really means you've engaged in a dialogue with your client. But I guess just 2 seconds on my background and how I got here. I went to Penn State. I was an accounting major. I then worked for Arthur Andersen. Hated public accounting more than anything, and came back here in time to see Penn State win its first national championship. So that was good timing on my part, and got my MBA, and then went into the world of finance. And I spent the first 12 years after my MBA in the corporate finance area as an M&A banker with a couple of different firms, really advising middle market companies on sales and IPOs, or transitions in their balance sheets, and also was part of managing a private equity fund. I was with a firm called Brown Brothers Harriman, which is today the last partnership on Wall Street, still owned by 30 guys. Pretty incredible. Doesn't happen much anymore. And we had a private equity fund and a mezzanine fund, which I was also part of managing. So that was fun. And then about 12 years ago, left Brown Brothers to join JP Morgan in New York in the private bank as part of a team assembled to develop a business in Pennsylvania, basically the Mid-Atlantic, and open an office in Philadelphia. So I did that for 3 years in New York, and then we opened the office in Philadelphia in 1999. Now there are about 20 of us on the private banking team. We manage about $13 billion in private client assets, and it's exclusively family money. We have no institutional clients. Our business is working with private families and across generations, and with their kids, many of whom are insane, and the parents are insane too often. But most of our clients are first-generation entrepreneurs. So they started a company. Some of them started several companies. They failed. They succeeded. And then when they get to us, as I just hit my microphone, sorry. So when they get to us, we say, we only get to meet the winners because the losers don't meet our minimums. And our minimum is $25 million. So we're really talking to the wealthiest people in the world. And in fact, in our office, our average account is about $60 or $70 million, that's very common for the private bank. We work very closely with other parts of the firm. So we work closely with the investment bank. Very often, the deals we work on are the deals that our investment bank is working on if they're selling a company or taking it public. So when you think about financial institutions today and how integrated they are, really the best way to outperform is to leverage all the different parts of your business. So what that means for people in the private bank is we have to be conversant across so many different things. Many people in our business have come out of the investment bank. That's not an unusual transition for us. So that's by way of background how I got to where I am today. When I left grad school, we didn't send a lot of people to Wall Street. I'd say that's fair. So I weaseled my way into where I am today. And I'll talk a little bit about that. And actually, I'd really like questions, and let's make this a dialogue too. And I thought I'd focus on a couple of things. One, just what is it exactly that I do? And two, you all, who I think mostly undergrads? Okay. Sort of, if you're interested in this as a business, just how do you get there? Because when I was in New York, I recruited at Columbia. And now in Philadelphia, I recruit at Wharton. That's my primary recruiting ground, both undergrad and MBA. And then whatever I can do for this program, we've tried to be as helpful as we can. I think we probably do a little more at the undergrad level in terms of hiring. And then we've had people out of the MBA program in our summer program the last 2 years. Okay. So we're trying to build more and more of a presence here. Now, as I say that, don't send me an email after this meeting with your resume, okay? Because I am not in the recruiting business. The hurdle I give to people, because this, particularly at the MBA level, is not a core school for us, if you can get an endorsement from Randy Woolridge, from the dean, or from one or two other professors that I might know, then we can have a dialogue. And that's also a screen for me, because that's what I have to do when I'm trying to get in front of somebody who is worth $100 million, and everybody else is trying to get in front of them too. So let me ask a couple of questions. I assume you're here, and this is billed as private banking or private wealth. I'd be curious from you all, what do you think I do? Yeah. Cold call individuals? Never. Good try, though.
You know what he does, don't you?
You decide the asset allocation for individual families and their needs differ, so you can try to decide what makes sense for a certain client.
That's certainly part of what we do. Any other? I walk dogs. Get kids jobs? No. Yes.
Who's your clients?
We do a little schmoozing. I'll tell you, though, it's interesting. I was out with a prospect last night. We were at Harry's in New York, which is a really cool, legendary Wall Street restaurant. But this is a guy who's worth $100 million, and he doesn't need me to schmooze him. He got there. We had dinner at 6. He flew in at 5 on his jet. So he really doesn't need me to schmooze him. We do that, but it's actually more fun for us. They get better tickets than we do, believe me. If you really want to do a lot of schmoozing, go into institutional equity sales. That's all those guys do. We call it romper room. We have an institutional equity desk in our office, and they're basically 2 senior guys and 3 junior guys. Their bill last year for car services was $90,000, taking them back and forth to baseball games. We work harder than they do. No other stab at it? That's a good question. I'm a managing director in our office. And the way we're structured, it's a little bit different from some of our competitors who are more brokerage-oriented. Our office is a team. So there are about 20 of us. There are 5 people who do what I do. As a banker, my role is to acquire new clients and then to be the lead person on that relationship once they become a client. And then I organize the resources around that client depending on what that family needs. And families are at all different stages of the liquidity cycle. Some still own private businesses. Their needs might be more focused on wealth transfer and planning from an estate standpoint, or liquidity, gaining liquidity from what is a relatively illiquid balance sheet. And then as they move along that liquidity spectrum, then we start thinking about things like asset allocation, managing liquid assets, and really thinking our clients' money will outlive them by generations. So our focus is not on will you run out of money or are you going to generate enough to pay your bills. That's not an issue. The issue becomes really often a legacy. Almost all of our clients have foundations for all different kinds of reasons. There are tax benefits to it, but it's really driven by charitable intent. So we have a foundation group that works with clients on how do you give money away. It's very difficult to give money away, believe it or not. So my job is to put together whatever team is relevant to that client at that time. And then we have people who sit on an investor desk of about, it's about 7 people. And their job is execution of the investment, investing our clients' money. We have a fiduciary team that focuses on trust and estates. We have a credit partner. And then client service, which is really sort of like the blocking and tackling of wiring money around, paying people's bills, things like that. So I sit at the top of that. That's not an ego trip, but that's my job, is to really quarterback that and coordinate those resources. All right, well, let me ask you another question. Has anything been going on in the capital markets in the last few weeks? Something's been going on. Come on.
You're going to have to network with him at some point. As well, press him while he's here.
What have you heard about JP Morgan in the last few weeks, for example? Yes. And what do you think about that? It's a good thing on whose part? It is a crisis, no question. I'll be curious to think, what you think about the crisis. Yep.
I don't even know if I would say it was helping out Bear Stearns. I mean, I think JP Morgan got a pretty good deal from it. I mean, obviously $2 a share would have been better, but $10 a share, at least from what I read about it, was at a discount, to say the least.
Maybe. I'll talk more about that. Yep.
Just sort of the overall, the Fed's questionable assistance in the matter, just provide $30 billion in liquidity.
It has. It actually ended up being $29 billion. We're actually taking the first $1 billion. That was part of the renegotiation. Anybody else have any thoughts on it? And this is a big deal. All right, so that weekend, that was 2 weeks ago now. That weekend happens, let's say we don't get a call from the Fed, and it's now Monday morning, and Bear Stearns declares insolvency. What happens?
Bear Stearns is sort of interconnected. They had clients that kind of ranged throughout Wall Street. If they failed, it was kind of recapping on the system. So JP Morgan really came out as the rescuer, as they have in the past.
As they have in the past. I'm curious. What do you mean by that?
Right. I remember reading, I forget the specific examples, but in certain times, in certain crises in the past, JP Morgan has kind of become the go-to company to rescue the system.
It actually happened in 1907. There was a panic in 1907 that was exactly what happened a few weeks ago and what threatened the system. And the prospect of Bear Stearns declaring insolvency on that Monday would have had a ripple effect because their counterparty, one of the biggest issues and changes in the capital markets in the last 15 years is really the emergence of counterparties to derivative transactions, to repos, overnight money. Bear Stearns is a huge counterparty in the repo market because that's how brokerage firms tend to fund themselves, through repos. So you could have an account at what's a local? M&T Bank. And you could be buying repos through M&T. Your counterparty could have been Bear Stearns. So what people thought it was overnight cash was actually in jeopardy if a Bear Stearns goes down or if a Lehman Brothers goes down. So the Fed steps in. And actually, just a quick history lesson, in 1907, same thing happened. Brokerage firms were way over-leveraged for lots of different reasons. And they were facing old-fashioned run on the bank. Remember, the financial system is a house of cards. And if you think about it very simply, I know you've heard about the multiplier effect, right? And just go back to how many people saw It's a Wonderful Life? Jimmy Stewart. This is It's a Wonderful Life. This is Mr. Potter. This is exactly what happened with a run on the bank. There was a run on the building and loan, right? And It's a Wonderful Life. And when everybody comes in to get their money, what does Jimmy Stewart say, right? He says, well, you can't have your money because remember, Bernie, your money is in your house and your money is in yours. And that's exactly what banks do when they intermediate. They take depositor money and they then take each dollar. And remember, a bank can leverage itself. JP Morgan is leveraged about 12 to 1. So for every dollar we take in, we can actually create $12 from that dollar. But if everybody comes back to get their money, well, they can't have it because that's leverage. You know, that's the issue with leverage. What happened to the brokerage firms is brokerage firms have very different capital requirements from banks. They're leveraged 30 to 1. Bear Stearns was leveraged almost 40 to 1. So when they had, in effect, a run on the bank, you know, they just, in effect, it's like, you know, couldn't come up with the money. It's like the building alone. So when you have that kind of a collapse, that's really bad for the financial system because even though many people have said, well, it's the bank's problem and you shouldn't bail them out, there is some truth in that. But the capital markets are the grease for everything else. When you think about industrial America, they need capital, right? So it comes from the capital markets. So what JP Morgan did, and actually, if you want to piss Jamie Dimon off, who's our chairman, just intimate that we took advantage of the situation. I was in a meeting with Jamie the week or the Thursday after that weekend, and he really bristles if anybody talks about, you know, we had 48 hours to do due diligence on Bear Stearns. And the way Jamie tells the story, it's kind of funny. In the meeting, our client said, so what'd you do this week? And he said, well, Saturday night I was at home and I get a call from Bernanke and Paulson, Hank Paulson and Ben Bernanke, the Secretary of the Treasury and the Fed chairman, saying, we really need your help getting this deal done. So we literally, so Steve Black and Bill Winters, who run our co-heads of our investment bank, Bill's in London, they come to New York overnight, and they literally have 48 hours to do due diligence on Bear Stearns. That's where the $2 a share came from. Because basically Jamie said, I'm not going to put my own shareholders at risk for this deal. And then you know what happened from there. It eventually became $10 a share, which is still, no question, that's an attractive price for us. But from the standpoint of the risk we took on, there was no way he was going to go above $10 a share. And then if not, who else is going to step in and Bear Stearns disappears, and then you have this ripple effect that we talk about. So, so that's the kind of stuff, frankly, that you've really got to know about in this business, because guess what kind of questions I was getting? And in fact, if I was sitting at Lehman Brothers or Goldman Sachs, I'd be getting these same questions from my clients. You know, what does this mean? I just got off of a conference call. I was telling Paul with a prospective client that currently has $3 billion in cash. And you know, you don't just walk up to a teller and give them $3 billion in cash, right? So their concern is, what do I do with all this cash? So on the call with me was the guy who runs our fixed income and currency desk, Anton Pill, who has 3 degrees from MIT, by the way, one of them a PhD, and he's an engineer by training. So you don't really party with Anton, but you want him to, you know, clients, he's a great guy. Clients have a lot of confidence in Anton. And this particular family at the moment has half of their money in repos. So I've been doing this for 12 years, and I've never seen people hang on every word when someone's talking about cash. But people are so concerned about cash right now that, you know, he was talking about this repo program and telling her things like, you know, the counterparty 2 weeks ago in those repos could have been Bear Stearns, and you're thinking of this as overnight paper. So, you know, something as mundane as cash has now become complicated. What people thought was cash really isn't cash. And it's become something that people really want to hear about. So I've learned a lot more about cash in the last 2 months than I ever cared to. You know, we're the largest hedge fund manager in the world, and I'm talking to people about money market funds. But again, in this business, we deal with the family treasury. It's not company money. It's not corporate cash. This is the family treasury. So, you know, people pay attention. And believe me, our clients are very smart and very sophisticated. So we really have to be at the cutting edge of all of that. So, so then I'll carry on for a minute about the capital markets and current events. So lots of volatility this year. What else is going on this year that's kind of a big deal? Housing prices have collapsed. That is a big deal. But what else is creating uncertainty this year? Well, yeah. What else? What's a really big thing that's causing uncertainty? Commodity prices are extremely volatile. We think they're going to continue to go up, but Come on, what's the other really big thing that's going on? Presidential election, right? This is an election year, and the market does not like election years because it creates uncertainty. And there's always a lot of speculation about what any candidate would do, when they're in office. And there's speculation all over the place. Who really knows? But that's the point. It creates uncertainty. So here I am. Let's go back to my client now. I've got $3 billion in cash. I ran a company. I don't know anything about the financial markets. There's a presidential election. Boy, JP Morgan, what should I do? Should I just sit in cash the rest of the year? The next 18 months? What should I do with this? Make a big donation to Joe Koza? No. No? I don't know the answer to that, by the way, but I was hoping you would. But that's the kind of stuff that is really important to our clients. And we express our views on the capital markets and on risk through strategic and tactical asset allocation. So every morning we have a call with our strategy team. Everyone around the world dials into this, and we talk about what's going on in the world and how we are expressing our views tactically. So that is something that I have to know every day, and I have to be able to discuss that with my clients and with their families. So one of the couple of things I want you to draw from this is you've got to have a real passion for the capital markets. And you've got to have a passion for current events. Because that's really what impacts me every day. That's what I have to have a view on. That's really what has to be expressed in how we manage client portfolios, what those views are. And if you're not interested in the markets, and if you're not interested in current events, it doesn't make you a bad person, but you shouldn't be in this business because it is really just, every minute we're digesting news, and every minute our strategy team is digesting the capital markets news, and then they need to act upon that. Because then the really scary part is we have views, but then we actually act upon it. We make tactical calls in our client portfolios that will be right or wrong, at least in a fairly narrow time frame. And that's our report card. And we, when things are rocky and volatile like they are now, again, our clients are pretty sophisticated and they're long-term investors, but they're still a little queasy. Is the world going to end? Should I have money in my mattress? And they're turning to us, and again, they're thinking generationally. And you have to be prepared, and you have to really want that responsibility, because it really is an enormous responsibility. Yeah.
Turmoil in the markets created business for you? If people are out there, literally created some phone calls that come in and said, I'm scared and I want somebody to a little bit more expertise than me, or a little bit more expertise than who's working with me now?
Well, I can answer that question empirically. In the last 2 weeks, $18 billion have flowed into the private bank from our competitors. So that, I think, is a result of people now beginning to understand how different firms run their business, what kind of risk that means from their standpoint. And other firms have been a beneficiary of that, too. I mean, we're not the only good firm out there. I do believe we are the best in this business. And that, to me, is just a testament to how people feel about how we run our business. And management is a big deal, too. Actually, I want to get to some of the things that you all need to think about, and I want to take your questions, too. But one of the other things I've learned in the last, since I started working over the last 25 years, is there really are good managers and bad managers. And I'm thinking now in terms of whom you decide to work for, because I've worked for good managers and I've worked for really terrible managers, and it makes a big difference. So when you're thinking about, what you want to do, make sure that you have the kind of passions that you need to be successful in the business because you like it. You won't be successful if you don't like what you're doing. But then you also need to think about the cultures of the different firms that you may want to work for, because firms are very different culturally. I didn't Didn't think a firm as large as JP Morgan could have such a significant culture, but boy, we really do. And we are different from other firms. And I don't know if we're better or worse, but we're certainly different. And only certain types of people would thrive in this culture, and they might thrive better in a different culture. And I'll give you an example. When I went to work for Morgan, it was the old JP Morgan. We were a firm of about 15,000 people. And we were the heritage JP Morgan going back to J. Pierpont Morgan, who was the founder of the firm. By the way, in that panic in 1907, just to finish that story, by the way, there was no Fed, there was no central bank. So when you had this run and panic, it was actually the man himself, JP Morgan, who took the heads of the largest financial institutions on Wall Street and took them into his library at 38th and Park Avenue and locked the door and said, you're not coming out until you solve this, until you all agree to work together and bail out the system. So we are directly descended from that guy, JP Morgan. So in 2001, JP Morgan merged with Chase Manhattan. And by the way, when I joined JP Morgan, as I said, it was 15,000 people. I came from Brown Brothers, which was 2,000 people. So I thought I was going to the biggest firm in the world. We're now 180,000 people, more than 10 times the size of the firm that I joined. So when JP Morgan merged with Chase, real clash of cultures. We lived through, and Chase acquired us. So we were the target company. And the cultures really did not mesh very well. There was a description of, we got a bunch of the business leaders together and we talked about this. And it was clear the JP Morgan people were kind of arrogant. And the Chase people were good people, hard workers, and we just thought of them as a retail institution. So you had this clash. And the private bank is actually a great example of what happened. The people who I like to think of as the thought leaders, our Chief Investment Officer, Mike Sembalist, Tony Worley, who runs portfolio construction, Anton Pill, the fixed income geek that I referred to earlier. Those were all heritage JP Morgan people who had been around for a long time. If you watch CNBC, you'll see Stu Schweitzer, who's been at JP Morgan since 1975. He's our strategist in the private bank. Guy's just incredible. But then all of the business leaders or business managers were Chase people. I'm not saying they were good or bad, but you had this huge clash of cultures, and the margin in our business went to zero because there was so much distraction. Cultures didn't mesh. It just didn't work. Our margin literally went to zero. And I don't know what would have happened. But we hung in there. And then JP Morgan acquired Bank One, which means we got Jamie Dimon, who is Jamie Dimon is an historical figure. And I'll tell you, when you leave here, if you have any interest at all, just read about Jamie Dimon. He is really a remarkable guy. And he's early 50s and just young guy. Jamie has this incredible grasp of the details of all of the different businesses that report up to him. And I'll tell you, the first thing he did, which was just, again, a statement, if you think about the different business lines that JP Morgan is in, asset management, investment banking, treasury services, commercial banking, and retail, then there's always the holding company and this line called administrative. Well, when Jamie took over as CEO, the administrative piece of the P&L showed a profit of $100 million. How can that show a profit? He said, we're clearly not allocating cost correctly. So he said, this is mine, I own it, and if you do a proper allocation, it actually showed a loss of $600 million. And he said, that's mine. He took that away from all the business lines. He said, you go run your businesses, I'll fix this. And it took him about 18 months to cut it in half and run the business much more efficiently. Jess Staley runs the asset management business, who we report up to. And he told Jess, you go run your business. You're accountable for it, but you go run your business. So Jess basically fired a lot of people. We shrunk. We made the business much more horizontal again, so that you cut out all these layers of bureaucracy. Our margin is now 40%. It was 0, and now it's 40. So the point of that is there are good managers and there are bad managers. And you want to work for good managers because It makes your life easier. It's more fun because you're working in a better business and you'll make more money. And those are all good things. So I'll stop for a minute, actually. I don't know, how are we doing for time? Okay. I'll stop for a minute and see if you guys, at this point, you have any questions. Does this raise any issues? Yeah.
What are the future growth trends in private wealth management? Because the European banks such as HSBC and UBS are reducing it to some
Yep. In careers in finance or in business disciplines in finance, it has among the best growth prospects of, if you think of it globally, and if you think of how wealth is being created around the world, the prospects are really phenomenal. And I'll tell you, the other reason is not just top-line growth in terms of people's wealth generation. It is still extraordinarily fragmented. We are the largest private bank in the US, and I believe the second or third largest private bank globally. Our market share is 4%. So we grow our business with a rising tide as people generate more and more wealth, but I also take business away from my competitors. You know, to the extent we can grow market share and, you know, penetrate further, 4% market share? I mean, that's, you know, the sky's the limit. This is a business of hiring good people. When I think about how we grow our office and our business, it's really by hiring good people who can acquire new relationships. That's really how you grow it. Yeah.
You said that you're not doing any sort of cold calling, obviously, because you're working with very wealthy clients. So how do you seek out clients, or do you find that they just come to you?
That's a great question. Because we're not in a business of cold calling. I can't call, you know, centimillionaires at home at night while they're watching television and say, hey, I've got a great stock for you. They would have the ability to find somebody to have me killed. I'm just kidding. Finding new clients, acquiring new clients is the lifeblood of the growth of our business. Because you get to a point where there's only so much you can do with one client. Now, I can't have 100 clients. I really can have about 25 or 30 clients. That's the most I can have because of the kind of service that we have to direct to those types of families. So when we look for new clients, there is no one way to do it. You've really got to always be juggling many balls. And the way we do it is, one, we partner with our investment bank. We have a group called the Investment Bank Private Bank Focus Group that's a team of about 5 people. About 5 people in the US and another like 3 or 4 in London who partner with the investment bank. They are over the wall. Asset management is on the public side of the wall. So we are not permitted to have inside information. The investment bank is on the private side of the wall. So if the investment bank is working on an IPO or the sale of a company, and we're organized by region, so my office covers the Mid-Atlantic. If that company is in the Mid-Atlantic, the focus group will then bring one of us over the wall to work with those clients. So we'll partner with the investment bank prior to the transaction, and then if the company is sold or goes public, we're there to help them manage their balance sheet. But we don't do every deal in the world. Goldman does deals, Morgan Stanley does deals, Merrill does deals. I want their clients too. So every week, the analysts in our office, which is the undergrads who are in our 3-year program, one of their duties is every week they run all of the news on the regions we cover to see, has a company gone public or filed an S1? Has a company been sold? Has a significant target of ours retired or gone through some type of a transition? Any reason for us to try to get in front of that person. So this happened to me yesterday. A company that I've been following in Pennsylvania announced it was going to be sold, and it's being represented by one of our competitors. So they'll put together all of the facts for me on the principles that we want to get in front of, and then we try to find some connect. Who sits on the board? Who were the advisors in the deal? Who's the law firm? What charitable boards do they sit on? To find any type of a connect to make that introduction as warm as possible. So if I find out that they sit on the Philadelphia Museum of Art board, I call up one of my clients who sits on the board, and I'll ask, if it's appropriate, would you introduce me to so-and-so? And they'll either say yes or no, and sometimes they say yes, and sometimes they say no. If they say no, then I'll try to find some other connect, and we'll exhaust that. And if we just come to a dead end, we have no connect to them, then I'll cold call them. But if you cold call them first, your odds of success are about 2%. So I will get as close as I can to making that as warm as possible. And when you cold call them, you never know. I cold called a founder of a tech company. This was in the 90s. Company was sold for cash. And I call one of the founders, and he agrees to see me. So I get to his office. He sold the company for his stake was about $150 million. It was cash. So I go in his office, and his office is about as big as this room. And his assistant makes me sit here, and he's sitting at the other end of the room, sitting at his computer. He's a tech guy, right? So he doesn't know how to talk to people. And he ignores me. So after a while, he pays attention to me, and we have an absolutely awful meeting. And I figure, well, you win some, you lose some. So I go home, and then next week he calls me and says, I'd like you to come out and meet my wife. All right. So I go out with one of my colleagues on the investor team, and we get to his home, and he's not there. His wife is there, and kids are running. He has 2 young kids. They're naked, and they're running all over the house. This is a true story. There's no embellishment in this at all. So the kids are running all over the house. The nanny's chasing them. And his wife takes us to the dining room and sits us down at the table. He finally arrives. He comes in. He sits down. He plugs in his computer. His wife serves him. It was salmon. I still remember what she was feeding him. And my colleague and I each have a glass of water. And he proceeds to eat and ask us questions. And we just have a terrible meeting. Terrible. It's like he's not even paying attention to us.
And you weren't fed too?
No, we had water. So, so he eats. Yeah, I mean, horribly rude. So we finished this awful meeting. We walk out. We're going to leave. And they lived on a golf course, which was really, beautiful private course. We said, oh, this is very lovely. Do you play golf? No. So we get in the car and leave. I figure, well, second shot. Didn't work. He wired us $100 million the next week. He's still a client, 10 years later. So one thing I have learned, I have no idea how people make decisions in this business. But you just have to, you do get to a point where you don't try to sell anybody anything, because you can't. They're too smart. You really have to represent very honestly what you do well. And you also have to be honest that you're just not a fit with everybody. I sincerely believe that the kind of people we talk to are talking to great firms, and they're going to get great service from anyone they ultimately hire. So they really have to like the people they're going to work with, and vice versa. If I don't like you, I really shouldn't work with you either, because that's just going to be a bad result, and life is way too short.
Yeah, you touched on it a little bit in that test example, but you described yourself as kind of the quarterback, as the managing director, and I was curious, what we as analysts would be doing, kind of on a day-to-day basis coming in out of school.
Right. Also a good question. Our analysts, it's a 3-year program, and we hire people with different backgrounds. We sort of lean toward people with finance and accounting, but we've had great success with history majors too, just people who are smart and inquisitive. There's a training program that everyone goes through to learn the different models that we use, and just sort of the blocking and tackling and the basics of the technology, and then introduction to things like asset allocation, and then they're thrown into it. Now, we have 3 analysts in our office, and what we try to do is, when it works well, the senior analysts are training the younger analysts, and it works more efficiently that way. What they do ranges from clients for whom we already are managing money. They'll do performance reporting, and get us ready for those more routine meetings that we have with clients. They'll work on what can be more esoteric modeling, like I made a private investment in real estate or a business or something like that, and what impact does that have on my liquid portfolio? And from the standpoint of risk management, what is the optimal allocation, taking into account the cash flow I need, the fact that now my balance sheet is dominated by an illiquid asset, what should the rest of it look like? So it's a lot of risk management modeling. And we use a model that's a Monte Carlo simulation. So what we try to replicate is within a confidence interval, what range of outcomes can you expect? And that's really to help a client make a decision that, I'm comfortable with this 90% confidence interval or I'm not. So there's that element of it. There is coming up the curve quickly on a couple of things that most people don't know. I knew nothing about this when I joined the private bank. The whole trust and fiduciary world, which is extremely complicated and actually a lot more interesting than you would ever think. And the derivative side of the business, which I knew nothing about when I joined JP Morgan, because our clients make great use and actually often in combination of derivatives and that whole trust and fiduciary side of the business. So, and I'll give you an example of that. About a year ago at this time, we had a family that is now a client, at the time was a prospect, sell a company, and there were the two siblings. But actually, you'll love this. This is a family worth $1 billion. The father is now liquid, about $600 million. And everything at his death will go to charity. And he has two children, they're grown, and he gave each of them, through these trusts, about $120 million. And this is the funny part, and that's it. They're not getting any more than that. That would be enough. So I just love that. And he says it with a straight face. But when you think about it, the other $600 million is going to charity, to the foundation. So the complex part of this was modeling those trusts. So what the analysts did in conjunction with what we call a wealth advisor, every team around the world also has a person who is a trust and estates lawyer by background. We have 38 of them in 38 different offices around the world. So he worked closely with Julia Fisher, our wealth advisor, to understand how these different trusts work, because each child had 5 trusts, and they were all different. So when we were modeling these, trying to decide on what kind of asset allocation was appropriate, we had to take into account, were they generation skipping tax trust exempt? If they are, well, then you don't really want to touch those. You want those to last for a long time because they have favorable tax treatment. Some had to pay out income. So we had to think about, in terms of asset allocation, how much income do we want to generate, because by the provisions of the trust, that has to be paid out. 3 of the trusts were created by grantor retained annuity trusts set up before the sale. So part of that had to be paid back to the settlor. And to make it simple, we didn't want to have to pay back, units of a hedge fund, for example. So the analyst had to model all of that, so then we could go to the family with our recommendations. That was very complicated, and actually it was a good result. And then from a marketing standpoint, there's that whole side of who are the targets in our area. They do all of the research on, as I said, if a company's been sold or if it's gone public, all of the research around who do we want to go after, how do we want to do it, generating things like pitch books. So they work till midnight every night. They work pretty hard. Yes?
When you go into these meetings for the first time, how do you prepare for them? Do you find that it's more formal, like PowerPoint type thing, or informal, getting to know the client? And do you find that it's mostly client driven, or are you making suggestions for what they should do?
Well, I said earlier, we always prepare a pitch book, but the best meeting is one where it's never opened. And I would say that was true, frankly, in the investment banking business too, because reliance on a pitch, you have to know what's on every single page, so that if you want to make reference to something, you can go immediately to it. So you have to have your pitch books memorized and know how you want to use them. But you never want to open. Actually, one of the things, and I'll talk more about this when we're done, but I keep a laminated copy of this on my desk. You might not know who Jimmy Lee is. But Jimmy Lee is one of the top investment bankers on Wall Street. He has been since the 80s. I mean, the guy is a living legend. And he works very closely with us in the private bank. He is one of our great partners. And he put together this 8 traits of a top producer. And one of his points on it is just, again, about flip books. And try really hard not to open the flip book. The more senior the client, the less it is about the flip book. You have to create trust and be genuine. On any given day, someone can beat you with price or product. You must have the relationship. A client hires a person, not a flip book, which is really true. And Dave Kelso runs our training programs, and as he likes to say, sincerity. Once you can fake that, it's his joke. I'm sorry, did that answer your question? Or at least in part? I will tell you the other side of it. By the way, by avocation, I'm a jazz musician. And improvisation is a big part of jazz music. Same thing when you go into that meeting. You have to be prepared to improvise. Yeah.
So some of the past few weeks we've been drawing the distinguishing factors between banking, sales and trading. Banking is analytical, sales and trading is quick-paced, fast thinking. And I guess wealth management is just more client-based. Just sort of what other qualities would you highlight that you've seen have been beneficial about your experiences?
It is different than sales and trading, no question. This is not a product business. We're, at the end of the day, it's really about developing a relationship. And I like to say, not developing a relationship because we're nice people. It's developing a relationship because they're very profitable. When you work with a family for 100 years, and we have literally celebrated 100-year anniversaries with families, that's extraordinary, and it's very profitable for JP Morgan. And hopefully, it's been profitable for the client, too. You have to like people. And I mean, genuinely like people. One of the real advantages I think we have is no one at JP Morgan in any business is paid on a commission. And I have friends who work in more commission-based environments, and they tell me that they eventually hate their clients because they only get paid when they sell something. And if a client's not going to buy something, then they really want to move on to the next phone call. And I don't have that in my business. And again, that's part of the culture of this firm, which is not ever about selling a product. As I said, you really have to like the markets. You really have to like current events. And you have to be a little bit of a Renaissance person because our clients, it's funny, this is all I think about in my work day. And frankly, my work days are 7 days a week. But our clients really don't think about this all the time, even though it's very important to them. They're interested in music, and they're interested in literature, and they're interested in sports. So part of it is, do you know what a mensch is? I'm not Jewish, and I don't know really much Yiddish, but there's a great book by a guy named Calvin Trillin, who writes for The New Yorker. And he wrote a great story about his father, who emigrated to the United States from, I think from Poland. But they were Jewish, and he used to tell his son, you might as well be a mensch. And a mensch is all the things that I think you have to be in our business. It really is, you should be a good person. You should really have that empathy for the person across the table, and I mean sincerely have empathy. Understand you're not going to like everybody, and if you don't, that's okay. So I don't know how else to describe it except go look up the word mensch, because it really is a lot of the qualities of people who are successful in our business. Paul?
Given the times we're in, market tank, something big happens. Given the sophistication of your clients, do you have to handle kind of panic? Do you have a day where it's like, I've got 25, 30 people I'm working with, and 20 of them are on the phone, waiting to talk to me?
Yeah. Honestly, it doesn't happen that often. Again, our clients are very sophisticated. They think more in terms of what's the opportunity in this. One, are we positioned well to protect capital? But also, what is the next step from an opportunity standpoint? The ones who are the most difficult, unfortunately I don't have too many of them, are the least sophisticated clients. And I'll give you an example. I have a family, they've been a client for maybe 3 or 4 years. They really didn't start letting us invest their money until about a year ago. They sat in cash. They were very nervous. They're a relatively smaller client, relatively speaking, and sort of tagged along with a larger transaction. So we started last March. They're about 60% in fixed income, about 25% in equities maybe, and then the rest is in hedge funds. They are down year over year 5%. One of the spouses left our meeting in tears. She was so upset that they were down 5%. And I'm thinking I'm going to get a hug because, we're only down 5% over the last 12 months when, markets are down 20%. Yeah. And I'll tell you, in a case like that, speaking very candidly, I'm thinking about firing them.
I was going to ask you if you ever got fired.
Me personally?
Well, I don't.
I mean, JP Morgan? Oh, yeah.
How's that feel?
Well, you can't take it personally because people fire you for all kinds of different reasons. I haven't lost many. We don't lose many clients. I'll be honest, but I would also be dishonest to say we've never lost a client because that's not true.
When you say you were fired, would you give them to another?
I'd ask them to leave. No, the firm.
The firm?
Yeah, leave the firm. We particularly when in the bear market after the tech bubble burst, it's really interesting what happened. Many firms actually traded clients because somebody would fire us and then go hire Goldman, and then a client of Goldman's wasn't happy with them, so they'd fire Goldman and hire us. There was just a lot of trading of clients in that time frame because they had to blame somebody, and you blame whoever you're working with. Yeah.
As far as like a workday goes, how much of your time do you spend actually analyzing investment, that versus dealing with clients, such as on the phone, talking to them, answering questions, stuff like that? So like percentage.
I spend less time analyzing investments than my partners who are on the investor desk. That's really the core of what they do during the day. So I probably spend 25% of my day thinking about that, and the rest talking to clients about whatever I need to talk to them about that day. Yeah.
How often do you talk with a certain client, and do you generate reports about their performance of portfolio, or do you just kind of have what they have and kind of mention them?
Well, on the performance reporting, it's not AIMR anymore. I forget what it's called now, but we're AIMR compliant in our reporting, which is the Association of Investment Management Research. They actually changed their name. It's some other acronym now. So our performance reporting is very robust, and we have complicated portfolios with structured products, hedge funds, private equity, real estate, as well as equities and fixed income, commodities, currencies. I mean, it's a complicated portfolio to analyze. In terms of talking to clients, we have clients we talk to multiple times during the day, and clients we talk to once a year. It really runs the gamut. It's whatever they want. Yeah.
What would you say on average clients expect, like a percentage basis, from you year over year?
Return. I got that question last night from a prospect. So, Joe, what do you think we're going to earn? And I said, if you're an equity investor, there's no way to answer that question in the short term. Where we are philosophically is, we think like endowment managers think, because again, our clients usually have infinite investment horizons. If you protect capital in down markets and you increase the probability of positive compounding, you will have more money. And my stupid example of that is I have $100. I invest it, and in the first year I double and I make 100%. I have $200. Second year, I lose 50%. I have $100, same $100 I started with. My average annual return is 25%. It doesn't make any sense, but it is, right? 100% minus 50 divided by 2 is 25. Average annual returns are very misleading. So our goal is I want to avoid that 50% down month, because if I can positively compound, I will have more money. My average annual return could even be lower than someone who has a lot more volatility. But we want low-vol portfolios that are generally non-directional, that have very low correlation to the equity markets. So that our goal, and I almost hate to say this in front of a client or a prospect because they always write it down, but our goal is to try to generate on average 1% a month net. Because if you can do that over time, you'll have more money.
Yeah, I was wondering, I know most of us in here are finance majors. I was wondering,
We love people who have as much accounting as possible because that's the language we speak. And sometimes people come in, as I said, they're history majors and have very little accounting. And we really want them to come up the curve in accounting because that's the language.
I know you recruit at Wharton in Columbia. If you were to leave these guys with, not that you should end here, but a final message about how to compete with those people, what would your comments be?
I'm actually going to read these 8 traits because they apply to the recruiting process too. But I will tell you that at the undergrad level, when I recruited those different schools, you guys don't have to play second fiddle to any of them. You really don't. What differentiates anyone, whether it's from Penn State or Penn or Columbia or whatever, is a couple of things. One is really having decided this is what you want to do. It's not like, well, if I don't do that, even if you have to lie to me, you really have to demonstrate a passion that this is what you want to do. Those who are most successful at both the undergrad and grad level in the interviews are not the people who read or who spout our website back to me. I know we manage 40% of the Forbes 400 money. I already know that. What really works well, and again, you guys have to figure out how to do this. Find an alum closer to your own age who works at JP Morgan. One of the people we just hired was, I think, UVA. And he just found a person who was pretty close to his own age and really did a deep dive into JP Morgan, really understood how we do this business. And again, didn't just read the website back to me. And was very sincere about it and had a real passion for it. So it's like taking a test. You really want to prepare as much as possible. And prepare, really go below the surface. Really try to gain an understanding of how we do it versus our competitors. That's very important. And then a lot of stuff that is on this page. By the way, as I said, this is just interesting stuff to read. Mary Erdos runs the private bank. Mary and I started at JP Morgan on the same day in 1996. She's 10 years younger than I am. She runs the private bank, and I work in Philadelphia. Mary talks a lot about the business in here, but one of the important things that I think she says, and again, this is deciding whether or not this is something you want to do. The interviewer asks her about work-life balance, and she basically says that's a bunch of hooey. She says, I always say there's absolutely no such thing as work-life balance, but there is a thing called work-life integration. And that's true. I don't disappear from my job when I leave the office or when I'm home on weekends. 2 weeks ago, I have a client who is an ambassador to a foreign country, and we manage $500 million for her family. She wanted to talk to me on Sunday morning because she's in a 7-hour different time zone. So Sunday morning, I was sitting in my sweatpants at my breakfast table talking to my client because that's what she wanted to do. And it can't be, well, I'll call you Monday. That's just the way it is. So very interesting interview with Mary. And then Jess Staley I would follow Jess into battle. Jess runs asset management, and this is just an article about our hedge fund business, which is the largest in the world. So let me just very quickly go through these 8 traits, which I think also apply to how you prepare for trying to get into this business or anything you want to do. Number 1 is courage. And the way Jimmy describes this is, it requires confidence. Ask for the business. And sort of like asking for the job, too, right? You can't just throw it up against the wall and hope they give you the business. You've got to ask for the business. And you've got to be very explicit about what you want. Don't leave it up to them to figure it out. And, clients and employers appreciate that. Energy. I love the way he says this. You've got to be passionate and you've got to be paranoid. And when I think about paranoia in our business, Mary always tells us, got to call your clients when things are good and when things are bad, because we have the best clients in the world, and if you're not calling them, your competitors are calling them. And that is absolutely true, and that applies to you guys too. And he says all the things that you would expect. It's hard work, have a sense of urgency, do your homework and be prepared, stay in shape, which is something I don't do, but I should, and then be paranoid. Everyone else is calling your clients and prospects all the time, so you need to be doing it too. Third is creativity. Solve the client's problems. It's about problem solving, not product selling. Again, absolutely true. Be well read, and be well read beyond, again, just beyond your business. And he says a lot of the same things about you've really got to love current events and what's going on in the world, because that's what impacts our business and our clients' lives. Frequency of contact, and this is a tricky one. It's tricky for me and it's tricky for you guys. Frequency of contact doesn't mean, I'll put this on you, that doesn't mean you calling me every 20 minutes or sending me an email 5 times a day telling me you want a job. That is the quickest way to lose my attention. Same when I'm trying to get in front of a prospect. I can't camp out in the bushes in front of his house, okay? Because it's stalking, first of all, which is illegal. Being desperate is not going to get you the job. It is a quiet confidence. It is a pleasant persistency is the best way I can describe it. And it is finding intelligent ways to get in front of someone, not just being too aggressive. That applies to me when I'm trying to get clients. That applies to you when you're trying to get a job or an internship. So it's frequency of contact, but it's doing it in an intelligent way. Connectivity. This goes back to, I think, your question earlier about, does the client drive it? Is it about looking at the flip book? It's really finding that connectivity. It's being a mensch. Actually, I'm going to call Jimmy and tell him he should also put in there, just be a mensch. And it is being genuinely interested in some of the things that interest your client. This family I mentioned to you that is sitting on $3 billion of cash. It's very hard to get in front of families like that. So we found our way in front of them through actually the advisory community. And I show up to meet the family advisor, not the family yet, because these families have gatekeepers. So I'm going to meet the family advisor, and he wants to see me Friday night at 5 o'clock at his office. And he's way out in the suburbs in Philadelphia. Actually, I was late because of traffic. The good news was he was late too. So I get to his office a little bit after 5 o'clock, sweating bullets, and he's not ready for me yet. So an hour goes by. And by the way, I have waiting on a conference call Catherine Keating, who runs the U.S. private bank, and Anton Pill, who's the fixed income geek I mentioned earlier. So they're waiting to then dial into a conference call with this guy. So an hour goes by, and we're emailing, like, I'm still waiting. So finally he comes down. I hope you're as patient as you look. He brings me upstairs, and I said, oh, it's fine. Catherine and Anton are waiting. And he says, well, let's make them wait a little longer. Let's get a cup of coffee. So we go get a cup of coffee. We start to talk. And as it turns out, he plays the guitar, which is great. So we spend the next 20 minutes, and I play the guitar, and I collect guitars. I have 19 guitars, by the way. That's my other passion. So we immediately connect on the guitar thing. And then we just have a great meeting. Now we're buddies. And will that win us the business? No, it won't win us the business. But he now thinks of me as a human being and not a vendor. The last thing you want to be thought of in any business or in any career or here, you don't want to be thought of as a vendor. It's the person I buy something from. That is a terrible position to be in, because I can fire a vendor tomorrow. If I think of you as an advisor and part of my inner circle, it's very hard to fire you. So that's connectivity, is what Jimmy calls that. Patience and persistence, which I talked about earlier. And again, I have people I've been calling on for 10 years. And I don't have any business from them yet, but I've developed a relationship with them, and they become my white whales. And someday, I'm going to do business with them. Now, I have to be careful, and I have to be efficient about who those people are. But they're obviously very attractive to me as potential clients. And what I tell younger bankers, and again, you have to do this in a way that is pleasant, yet persistent. Don't go away until they tell you to go away. And that almost always results in a relationship. And then this is a good one too. Follow the cardinal rule, which is always speak to the principal. So I had this meeting a few weeks ago with the gatekeeper, And my goal at the end of this was to get the principal into the room, which we did. So now we have a direct dialogue with the family member and who ultimately is going to make the decision. So, you know, it's, again, sort of the same thing when you think about recruiting. And this, again, this is a balancing act for you. The human resource people are very important. I work very closely with the Dan Temples of the world. You know, those guys are my partners too. But at the end of the day, Dan's not going to make the decision. The business people at the business line are going to make the decision. So again, ultimately, you treat every gatekeeper with respect. And in fact, you treat them like the principal. You treat Dan Temple like he's going to make the final decision. But also know that he's not. That's important. And then the last thing we talked about earlier, activity, lots of balls in the air. You know, because it is a numbers game. Again, I don't want 100 clients, but I probably want to generate maybe 3 or 4 new clients this year. I probably have to talk to 10 times that many to get that kind of a result at the end of the day. Because all kinds of things happen. You don't get hired. You know, I have a guy I've been working with for the last 6 months. Well, in this market, and he was going to achieve his liquidity through the sale of a company to a SPAC. Deal fell apart. So, you know, he's still a good guy, and I still want to do business with him. He doesn't have any money. So he has lots of net worth, but it's illiquid. So lots of stuff has to go on. All right, well, that's really all I had to say. Any other final questions are fine.
I will try to put together something on Angel, the points that Joe made, and maybe some of the articles.
Yeah, I'll leave this with you. I would just don't use Jimmy's name. But,
No. So let's give a big round of applause.
Thank you. Always a pleasure.